Hello, Mark here from Success with Options. Vertical spreads are a popular options trading vehicle that offers a number of advantages for the options trader. What I will be doing in this short video is going over some of the basics of a vertical spread and then jumping right into an example showing how to set up a trade, calculate position size, and enter the trade. We'll also talk a little bit about monitoring the trade and exiting. Vertical spreads are made up of two options held in the same month. One option will be sold, the short strike, and one option will be bought, the long strike. The vertical spread will either be two put options, making it a put vertical spread, or two call options, making it a call vertical spread. In my mind, there are two key advantages of the vertical spread. First and most important is the fact that it has limited risk. As we'll see in a minute, I know exactly what I'm risking and exactly what I can make before I ever enter the spread. Second, vertical spreads can benefit from time decay. That means that in many cases I don't need the stock to go anywhere to have my vertical spread be profitable. There are actually two types of vertical spreads, the long vertical spread and the short vertical spread. The long vertical spread will be made up of a purchased option, the long strike, that is more in the money than the sold option or the short strike. Because of this, the long strike will cost more to purchase than what I make from selling the short strike. Therefore, this spread will be put on for a debit. In the ideal scenario, I will realize my maximum profit when both options expire fully in the money. By contrast, the short vertical is made up of a sold option that is more in the money than the long strike. This means I will receive more for selling the short strike than what I pay to buy the long strike. This position will be put on for a credit. In the ideal scenario, both options will expire worthless in order to realize the maximum gain. Let's actually look at an example to help illustrate the two types of spreads. What we see here is a chart. It doesn't really matter right now what symbol. This chart is in a bullish trend. Therefore, we want to put on some kind of bullish position to take advantage of the trend. We will create a long call vertical spread by buying a call at $50 and selling a call at $52. Notice here that the long call is in the money by almost $5 while the short call is in the money by just over $2. The result is that this spread will be put on for a debit of $1.45. What's the most we can make on this trade? We have a $2 spread where we bought the $50 strike and sold the $52 strike. If the options expire with the price over $52, the spread will be worth $2. But we paid $1.45, so that will leave a max profit of 55 cents. What's the maximum loss? If the stock opened tomorrow at $40 and stayed there, this spread would expire worthless and we would lose $1.45, which is what we paid to enter it. So what we have here is a maximum gain of 55 cents and a maximum loss of $1.45. Let's now look at an example of a short vertical spread. We have the same bullish chart where we want to enter a bullish spread. We could create a short put spread. In this case, both the long and the short puts are out of the money, but the short put is more in the money, or at least closer to the money. Notice that we are using the same strike locations, but whereas for the long vertical we bought the $50 call and sold the $52 call, in this case we're buying the $50 put and selling the $52 put. If this is confusing, pause the video for a moment and take a look at this vertical spread. Puts are a little more confusing at first, so it can take longer to get used to them. Since we are selling the $52 put, which is closer to the current price, and buying the $50 put, we will enter the spread for a net credit of 55 cents. As I mentioned earlier, the ideal outcome is for both options to expire worthless. As long as the stock stays above $52 at expiration, this will be the case, and we'll get to keep the 55-cent credit. But what happens if the stock falls to $40 tomorrow, assuming, of course, we've entered the position? At this point, we are fully in the money on both options and will have a total risk in the trade of $2. However, we initially received 55 cents for the position, leaving us with a max loss of $1.45. Does this put spread example seem a bit confusing? Are you asking why you would use puts to construct a bullish trade? The simplest way to resolve this is to ask yourself what you want the stock to do. If you have sold a $52 put, you have an obligation to purchase the stock at $52. If the stock falls below $52, there's a chance the buyer of that put option will invoke his right to sell at $52. In our example, we see that the maximum loss is realized when the stock falls below our option positions, and our maximum gain is realized when the stock remains above our sold strike. If your preference is for the stock to stay above $52 or even move higher, you have a bullish position. I chose the same exact strike prices to illustrate the fact that in reality the short vertical and the long vertical can have the same exact characteristics, and We could have easily found a bearish stock where we could construct a short call vertical and a long put vertical with the same characteristics. In reality, though, I tend to trade long verticals and short verticals differently. I look at long vertical spreads in terms of what I don't want to have happen, and I look at long verticals in terms of what I do want to have happen. I will usually build long vertical spread, at least partially in the money, whereas I'll construct a short vertical spread fully out of the money. Well, I'm going to finish this video by using a short put vertical spread as an example. What we're looking at here is a trading platform provided by thinkorswim, a leading options brokerage. One of the cool features of having a thinkorswim account is the ability to also have virtual trading accounts where my experience is almost exactly the same as if I were trading a real account. Let's begin by taking a look at a chart of a stock, or in this case an ETF, that is in a bullish trend. EWZ is an ETF of Brazilian companies, Brazil being one of a number of emerging markets. You may recognize this chart as the one we were looking at earlier. Since we began talking about vertical spreads, EWZ has actually sold off a little bit, but it still remains quite bullish. Notice here we have several points where we're experiencing, where we've seen some different pullbacks, and you might consider these little pivot points here. Let's just highlight these. And in fact, we can also see points where we've established a point of resistance where resistance was broken, and we continue to move higher. So as long as we remain in this uptrend, we have pretty much a bullish opportunity, and this pullback, rather than being something to be concerned about, might actually offer us a better entry than what we were talking about earlier. Okay, so a couple of different things we can look at then in terms of where we might want to position a vertical spread. What I want to do is put on a short put vertical spread, which will be bullish, and what I would prefer to do is put that on out of the money and actually below at least one level of support. So what I might do is I might choose to put on a short put spread where my short put is right here at $50. I'm just going to change the color to help us see this a little better. Thicken that line up a little bit. Okay, so what I'm going to do is sell a 50, and then I'll probably try and put together a $2 wide spread like we've been talking about, but since we've moved down a couple of strike prices from the price that we talked about earlier, what we'll do is we'll sell a $50 put and we'll buy a $48 put. And that will give us a $2 wide strike. Let's go over here to the trading platform and see what we can get. One of the nice things about the thinkorswim platform is how easy it is to put together a trade. So if I want to sell a $50 put and buy a $48 put, one of the ways that I can do that is to just right mouse click over the top of the $50 put. We're actually in the put column here, call column on the left. So I'll right mouse click over the $50 put, go to sell, and I could sell a vertical, but that would be one strike wide. I want two strikes wide, so what I'll do is I'll swing down here to deepen wide, 1 month, 2 strike vertical, and I quickly have put together a $2 wide spread that is currently trading for 50 cents. I'm sorry. So we have a $2 wide spread for which we can receive a $50 credit. Now, since the $2 wide spread gives us a $2 risk, our actual risk in the trade will be $1.50. It's kind of nice round numbers for us to work with. So what we can do then is begin to think about, okay, we have the spread that we're looking at and ready to trade. What would be the optimum position size that we're trying to work from?